Hi, everyone. This is Gary Lai, the 2023 AREAA Mortgage Chair. I hope everybody had a great Memorial Day. But it is Tuesday, so we're right back into it. So today I do have three panelists here I'm very excited about. They're going to share their knowledge regarding the use of the reverse mortgage, the negative connotations, as well as the practical applications of it. So my three panelists today is Mr. Tom Ritter from AREAA Home Loans. So Tom Ritter entered the residential mortgage market all years in 2008. He was hired as the head of the reverse mortgage division of a promising new mortgage bank, AREAA Home Loans. Over the past 15 years, he's seen many changes in the market and currently manages his own book of business. He is also tasked with assisting and coaching AREAA loan originators around the country with their reverse mortgage clients. Well, thanks for being here, Tom. And yeah, you definitely got into the industry at a very interesting time. Like,
yes,
a transition in career wasn't enough. You had to make it more difficult for yourself.
That's right.
Thank you. We have Mr. Des Lenz, a director for AP Mortgage. I'm sorry, Des.
Yeah,
so finance.
I head up American Pacific Reverse Mortgage Group. So, and my title is director. Yeah.
He started the mortgage business in 1992, shifted focus to just a reverse mortgage in 2000, and in 2005, he became co-founder of the American Pacific Reverse Mortgage Group, a top 20 reverse mortgage originating company. He's a director of the company, and his mission is to show people how reverse mortgage can be a useful financial tool for many situations. Thanks for being here, Des.
Thank you.
And last panelist that we have is Mr. Harlan Okola. He's been in the mortgage industry for over 20 years. He's now the National Reverse Mortgage Director for Movement Mortgage. He's widely recognized as an authority on reverse mortgage loans and retirement finance issues. Well, thanks for being here, Harlan.
Thank you.
Can't wait to actually hear from all of you and discuss sort of what we really don't know about reverse mortgages. So I guess my first question for everybody is, what is a reverse mortgage? So whoever wants to sort of
Well, I'll take the high-level answer to that. It is a cash flow solution for senior homeowners in their retirement. So when a senior, anyone over 62, and in some cases younger, have equity in their home, sufficient equity, they can utilize that equity for cash flow, for needs to supplement their retirement, or to achieve special financial goals in their retirement. Anyone would like to add to that?
Well, one of the things that I mentioned to clients that are saying, how does this work? Everybody knows how a forward mortgage works. Everybody says, what is a forward mortgage? Well, forward mortgage is a loan that requires payments that you keep paying for 360 months or 180 months or whatever the term is. A reverse mortgage simply reverses the process and sends money back to the client. So we put money into IRAs, we put money into 401ks. When we get older, we take it out. A mortgage can now, because of reverse mortgage, be the same way. You put money into your house, you can now take it out by waving a magic wand called a reverse mortgage. And a lot of people don't like to take money out, but it simply makes a lot of sense when you put up a whole bunch of money in for 20, 30, 40 years.
Just to add a slight amount to that, good answers, I think. And its basic form, it's a home loan. And it's not a government program. It's a home loan that allows a borrower to access some of their home's equity or to buy a home and have no required P&I payment. They still got to pay property charges, taxes, insurance, do maintenance on the property, and it has to be their primary residence. So in a nutshell, it's a loan. And it's a loan, as Harlan and Tom point out, for specific benefit to a senior client.
All right, so then you just said it's a loan, right? So in the traditional sense, a loan is a security instrument that we have to pay back. So how do you pay back a reverse mortgage? And so obviously, obviously somebody has to pay the balance back. So how does it work? So can you explain a little bit more in depth?
Yeah, Gary, that's something that I should have really added to mine, and I'm sorry that I didn't. This is a loan. This is not an ownership change. Everybody thinks it's an ownership change, and the way you pay the loan back is to give your house away. Nobody wants to give their house away. They understand what a loan is, but they certainly don't want to give their house away. So the issue is that it's like any other loan, and it has specific terms. The term is that you don't have to pay it back until you're 150. Or whenever you permanently move out of the house. So I just did my loan and it's due sometime in 2110 or whatever. So it's a long time into the future, but you do have to pay it back, but it's not you and it's not your children and it's not your estate. It's the equity in your home. It's the only loan that is designed specifically to be that you are allowed to pay it back with home equity instead of cash. And if there's not enough, FHA steps in and protects it. So it is the safest home loan that you can get because you don't have to pay it back while you're alive. Your kids don't have to pay it back. Your estate or your trust doesn't have to pay it back. What it gets paid back by the future equity in your home. And if there's not enough, the Federal Housing Administration pays it back without any ownership change from that perspective.
Yeah, one of the things that I do when I'm explaining it to either professionals or to clients is that, as Harlan had mentioned, everyone understands how a 30-year fixed loan, standard loan works. A reverse mortgage is a negative amortization loan, which means that the balance of the loan goes up over time. And the simple way that I explain it is that every month that you would have made a payment on this loan, it goes to the balance of the loan. And the balance of the loan goes up over time. So that is a very important aspect of the loan to understand for the client, to see where the balance of that loan is over time and what the exit strategy might be if you intend to live in the home the rest of your life. How do you pay that off, right? Or if you'd like to move or you're forced to move, or if a spouse would like to move after the other passes. These are questions related to this negative amortization of this loan that I like to cover early on with explaining it to a client.
Okay. So I guess my other question then, because you just mentioned neg am, right? And that has a very negative connotation in the mortgage industry. So what are some of the negative connotations or negative impressions that people have on a reverse mortgage? What do people think that is actually not true?
I'd like to throw that out. Neg am is something that kind of partially created the problem back in 2008, negative amortization on loans, but they had a limit. And in 2008, when everything crashed, it was specifically a part of the reason was obviously there were very bad mortgage products and so on. And some of those bad products specifically were neg am loans. And so that is one of the things that crashed the market. And so a reverse mortgage has the protection that there is no margin call, so to speak, that when it gets to a certain point that it goes into foreclosure. There is the only margin call is when you pass away and you permanently move or you permanently move out of the house. So it is something that is protected by the Federal Housing Administration in an insurance program. So you can never be truly upside down like you could be in a regular negative amortization loan that happened during 2008 when interest rates either increased or home values plummeted. And it doesn't have to be negative amortization. I plan on making some payments to my reverse mortgage because I will get some tax deductions. I don't have to, but the payments are optional. So unlike some people that think that a reverse mortgage is guaranteed to be a neg am loan, if you want to take some of your cash and put it into your mortgage, we always accept payments on reverse mortgages. So if you want to make a payment, that's fine, but usually there's better places for it to go and you're better off putting it on your home loan balance than making a payment. And so you have the option every month. I get a statement every month that says this is not a bill. which is kind of cool because it's one of my biggest loans. And it says this is not a bill. So I can make a payment if I want, it's optional. If I don't want to make a payment, I don't have to. And so it's truly different than any other negative amortization loan out there.
So Gary, one of the things you're asking is like, you know, in a way, what's the negative of this product? And I don't, in my conversations with clients, it's not that we're talking about negatives, we're talking about things to think about, okay? And one of them is that, as being pointed out, that loan's growing bigger over time if you don't make payments. And the value of your home is presumed to go up too, but it can, and when you talk to clients, I say you're making a conscious decision that you could use some or all of the equity in your home over time for the benefit of improving your financial life in retirement. So it's not that that's by itself negative. It's something they definitely want to be aware of, you know, that over time it could eat into the equity that they have for their heirs. And the other thing is there's, you know, significant closing costs, like take a regular FHA loan. You got upfront mortgage insurance, perhaps an origination fee, all the other fees involved. You're going, there's significant cost to obtain the loan. So it wasn't built for the short term. It's built for the long haul. So as far as that client can look into the future, if this is the house that they are going to live in, then you go, this might be the appropriate solution. So those are the couple major things that come up in my conversations, and we want to have that conversation about things you should think about.
Anything you want to add, Tom?
No, well, one of the points that Des had mentioned earlier before we started was there are characteristics of the product, and they can be deemed as negative, but they're just aspects, they're functions of the product. So just understanding the details of the loan is critical when pursuing a reverse mortgage, so that you understand what it can do for you and what the costs are. There are benefits and risks to every financial strategy that you take, and this is pretty low risk, but it's only low risk if you understand it. If you do not understand it and you endeavor in a reverse mortgage, that's where the danger is. And I think that's where Des and Harlan and I really focus on education and making sure that the client understands how it works.
Got it.
Can I add one thing to that, Gary?
Yeah.
There's required counseling with this loan. And so, you know, we're allowed to and required to hand a list of counseling agencies to the client, but they have to pick the counselor, they have to make the appointment, they have to pay for it. We can't attend. We can't put a little mark by a counselor and say, these guys are pretty good. The idea is that it's an educational checkpoint for the client so that they have to go through this process. It takes about an hour and 15 minutes, costs nowadays, I don't know, 150, 175 bucks. And the point is that they get to ask any question that they feel they didn't have enough information on. They also get led through a series of questions in a conversation to make sure they understand how it works so they make a great decision about this is what I should do. And they can invite whoever they want to it, you know, like their kids, financial advisors, so they can make a good financial decision on the product. So that's a checkpoint you don't see in, you know, traditional home loans. You know, you apply, you get it, you got it. This one, you're going to go through a process. And in California, there's a 7-day cooling off period after counseling before you can do a full and complete application. So the idea is that, you know, there's protections in place so that somebody can make a good decision.
Gary, there's a couple of in the Q&A and the chat, Rika had brought up some things which I think should be addressed now, because the fact is that I wrote a chapter in my book, which I can make available to some of the folks that are on this call, called Drug, Sex, and Reverse Mortgages. And it happens to be the most read chapter in the book. People usually turn to that first, even though it's chapter 6. And, you know, the fact is that drugs can kill you, with an overdose, or they can save your life. Sex, of course, can be good or evil. Reverse mortgages can be good or bad. So are 401ks, so are insurance policies, so are cars, so are anything that you purchase. Things can be good or bad. And when people say reverse mortgages are bad, which is what I used to tell people before I understood them 20 years ago, it's simply an ignorant situation that, well, just a minute, what's bad about them? The issue is that there's something called the cost of living. And I saw a sign outside a church a long time ago and said the cost of living is high, but it's still extremely popular. So when we get to retirement, we have to spend money from somewhere. Either it's got to come from Social Security, we got to go back to work, or we get it out of our IRAs or 401ks. The catch with a reverse mortgage, if there is a catch, is that we're pulling equity out of our house, which is no different than pulling money out of our 401k. It's no different than pulling money out of our IRA. It's no different than pulling money out of our savings account or drawing Social Security early. It is money that we deposited, and it's equity. And one of the things that I talk about when I'm talking with clients is, why is home equity a sacred cow? Why can you not touch that? We created a bunch of wealth in our homes over the years. Why can't we use that wealth to help our kids, help our grandkids, help our own lives to have a better life and a better retirement from 62 to 92? And what's odd is that people say, well, yeah, but they're expensive. And yeah, but you lose equity. Well, if I take money out of my IRA, I lose 401k money. If I take money out of my savings account, I lose money out of my savings account, but I don't lose it, I'm spending it. So I just choose to spend money out of my house instead of spending money out of my IRA, which there's been a tremendous amount of research done that I will end up being able to give more to my children. I'll be able to give more to my grandchildren because I did not pay off my house. People that paid off their house are going to be able to give less to the next generation because they don't have as much money in other areas. And that's something that most people don't think about is, yes, I will die with less equity, but I will have given my kids and my grandkids more while I was alive. And I've enjoyed life more because of the fact that I can't take it with me. And it makes more sense mathematically to take money out of my house instead of taking all the money out of my IRAs and drawing Social Security early.
I mean, I think the common point that you guys, all three of you guys brought up is definitely about the education part, right? People need to be educated regarding the product and why it is good for them. So I guess my next question is, who is the right candidate? Or who is the right person for a reverse mortgage?
Boy, that's a broad question, because as it turned out, when I do presentations, I have a Phillips screwdriver and a Leatherman tool. And I show the Phillips screwdriver. I say, this is what I thought reverse mortgages were when I started doing them in 2000. This one product that fit one scenario, somebody that was really struggling financially, we use it and life's good. But it turns out with time, changes to the program experience, learning, it's more like this Leatherman tool. Yeah, there's a Phillips screwdriver on there, but there's pliers and a traditional, screwdriver and file and a knife. It turns out it fits so many different scenarios than you might think. The ideal person is, there's no one definition. Now, somebody that's struggling financially, this could be the tool to eliminate their monthly payments, so that improves cash flow, perhaps allow for a line of credit for future use and a monthly payout to them, so they improve cash flow all around, right? So they're using this asset. So that would be somebody that, is a needs-based borrower. But they've shown studies where, like, mass affluent people that have significant investments, maybe they've got $1 million in between equity in the home and other investments, but they could use a reverse mortgage with the line of credit sitting in the background as a tax-free source of money to use, as Harlan's pointed out, use that money instead of using your 401k. Use that money instead of using your IRA in a bad stock market. So it's really situational. When you sit down with somebody, it turns out that unless your name is Bill Gates, you probably should at least look at it and see if there's an applicable benefit to you. I know it sounds a little weird, but you can use it with realtors to move into the right size home, downsize, upsize, and eliminate a monthly payment. Financial advisors talked about that buffer asset. So there's just a lot of use for different people. You asked me what time it was, and I told you how to build a watch. Sorry about that, but you know, it's one of those things that there's just doesn't seem to be a single ideal candidate.
I have to agree with you. There are so many varied applications, and maybe a different answer to your question might be someone who is 62 or older, who has equity in their home, and would like to utilize their equity as a part of their retirement portfolio in some way. Oftentimes people have equity locked up in their home, and they may be drawing from their retirement, which at times might be painful if the market's down, drawing from their savings. They can utilize it as a portion of their retirement portfolio, but you must have the equity in your home, and you must be at a certain age. That's the starting point to identify who can benefit from a reverse mortgage. How about you, Harlan? Do you have any comments?
I do. I thought I was muted there. I was looking to unmute. I think that what I found is that over 90% of people over 62 can benefit from this. That doesn't mean that 90% of people need it, but in my 20 years of experience, there's very few people that can't benefit. It's kind of like saying, I wonder who would benefit from Social Security. I wonder who would benefit from having a 401k. If Pauline said that it's one of the greatest wealth opportunities that has been created, often it's a person's largest asset. And the fact is that it's not a good asset. It's not a good investment if you can't use it. And it's only something that can be passed on to the kid. Imagine going into a financial planner and say, I'd like to take some money out of my 401k. And the financial planner said, oh no, just keep sending money in. We're going to give that to your kids when you die. You can't have that. I mean, you fire that financial planner. It's weird that people very rarely walk into our office and say, hey, I gave you guys hundreds of thousands of dollars. I'd like some of it back. And, you know, they usually don't. In fact, when we offer it to them, sometimes they get mad at us and say, no, you can't take my house. We don't want your house. We'll just give you some of your money back that you gave us for the last 40 years. And so that's what you do with financial advisors. That's what you can do with real estate, that you have done a great job of making a decision to buy it. And it really goes especially to our next generation. There's very few people that I've ever worked with that don't care about the next generation. Almost everyone is concerned about leaving a legacy to their children and their grandchildren, which often includes money. They want to leave a legacy of an example and you know, wisdom and so on. But there's a lot of people that want to leave a legacy of money. And sometimes that legacy is a house. The fact is I'm giving my kids money and time now and wisdom and advice because I want all 4 of my kids to have a house. I don't want them to wait until I'm 90 and they're 60 to inherit my house. And we can, the biggest wealth gap in this country is in retirement, is between people that own houses and people that don't own houses. And in retirement, people that don't own houses are in rough shape and at the mercy of landlords. And so if we can teach people in their 20s and 30s right now, even though interest rates are higher, to buy a house. I bought a house at 16% back in 1981. If I would not have done that, I wouldn't have the housing wealth that I have today if I wouldn't have started with that first house. And that's especially important, I think, for the Asian real estate group, is that we can help a ton of kids and even grandkids right now. If grandparents would help them, if they don't need the money, if they can help the kids and the grandkids, for goodness sakes, help them now. Don't wait until 10, 20, 30 years when you die to help your kids and your grandkids get a house.
Got it. So basically, a lot of them can be helped by getting a reverse mortgage to potentially help their grandkids have a down payment for a house now, rather than, God forbid, they pass away and then they get that inheritance later on, 10, 15 years down the line, it sounds like. So I guess my next question
by the way,
obviously-
excuse me just
Yes.
for a second, Gary, somebody just did a follow-up question on that. How does that work? We just had a lady in Seattle that owned $1 million home that was paid off. Her 2 kids could not afford a house. They'd have to move out of Seattle. And she didn't want them to because she wanted to be with her grandkids. She simply took $400,000 out of her house, gave $200,000 to each, her son and her daughter, and both of them were able to afford a house because they had this great big down payment. Will they get a smaller inheritance? Probably, because she took $400,000 out of her house, but they get an inheritance today. And what will their house be worth 10, 15 years down the road? Because now they're building their own equity instead of having to wait until mom and dad die and rent all that time period.
Right.
And then are they both going to move in together?
Right.
There's only one house and there's 2
I
kids.
guess the other important thing is the fact that that mom is not saddled with a large sort of monthly payment now. You know,
Right.
That's definitely, especially when you're on fixed income, you know, you are trying to manage your budget. So I definitely understand that. So you did talk about tapping the equity of the house, right? Can you actually use a reverse mortgage to, let's say, purchase a home?
Yes. So the reverse mortgage is, again, a loan. And so you calculate the loan amount by the age of the youngest borrower, the current interest rate, and the sales price of the home they're buying. And it calculates a loan amount, and the difference between sales price and net loan amount is the down payment. So you use the reverse mortgage to buy a home and have the monthly payment. So, you know, and to your other example, she took money out, gave it to the kids. But the interesting part about that money is it's tax-free. So if she handed out $400,000, if she'd gone to, say, an AREAA and pulled out 400 grand, that would have been a significant tax benefit, you know, hit. And in this case, you're using non-taxable money to benefit the kids. So, you know, that one's a really good point when you're looking at especially big numbers like that. But to your point, yes, you can use a reverse mortgage to purchase. Oftentimes you might see somebody at Harlan's talking about $1 million house in Seattle. That might not be much of a house, but let's say it's $1 million house elsewhere. And it's a big house, but they still have a monthly payment. Say the loan amount they have in the house still $500,000. You use they list the house, sell it, take the net proceeds, combine it with a reverse mortgage, buy the ideal sized house because that one was too big, too much maintenance, that kind of thing. And now they have the ideal home with no required monthly payments. So they improved their cash flow, got into the right house. And it's one of those things that realtors can do to intentionally target people that have the potential to get into the right size home and get a listing and sale and help them in the process by having this knowledge.
You know, there's a lot of people that would like to buy. I wanted a nicer house by our kids and our grandkids when I was headed for retirement. So when I turned 62, we bought a house that was more expensive than what I would have bought if I had to make a payment or if I had to pay cash. And so when you can bring in 40, 50, 60% down and never have to make a mortgage payment, that means that I could buy $1 million house, for example, for $600,000 down. Otherwise, I could only pay $600,000 cash. Will my kids have more equity at the end? Probably, because even though I bought the house with a reverse mortgage, there's a greater chance of $1 million house going up to a greater level than a $600,000 house because of repairs and because of the area and so on and so forth. So buying a house with a reverse mortgage and not paying cash is actually the wisest way to do it. And we proved it with thousands of Monte Carlo simulations. One lady came to me to an event that I was speaking at, and she said, you know, I just don't believe in reverse mortgages. And I said, well, that's okay. This is not a faith-based program. You don't have to believe in it. You just have to understand math. If you understand math, it'll make a lot of sense to you. So let's just look at the numbers, and it doesn't matter how you feel about it. It just matters what the math comes out. And if I can buy $1 million house with a reverse mortgage instead of a $600,000 house for cash, let's look at the numbers over the next 10, 20, 30 years and make some assumptions. And since that time, she actually got a reverse mortgage herself. So she does believe in them now, but she wanted it to be proved with math first. And we're pretty good at math because that's the business that we're in.
Yeah. So you brought up basically a tax advantage, right? You get the money as tax free. So Pauline just did ask a question in the chat. Does having a mortgage on the home help with estate planning? Would the estate be taxed on the equity or the entire value? I thought that was a very relevant question to this very quick conversation. So can you guys speak to that question?
Well, it's super important. And the first thing I got to say, because of our attorneys, is I am not a tax advisor and I do not give tax advice. However, I can tell you what I looked at personally, and I spent a lot of time with Dr. Barry Sachs, who has his own reverse mortgage in Napa, California, and understands these things inside and out as a tax attorney. So I talked to him specifically, and he actually wrote an article. If I put my email in there, if you'd like to have a copy of it, called The Loss Deduction. It can be a huge deduction for the kids at the end against anything that they are potentially inheriting, including IRAs, not just the equity in the house. Now, you usually get a step up in basis on the house, and so that usually helps you. But I'm going to have at least $150,000 in tax savings because I have a reverse mortgage, because I can decide when I'm going to pay my mortgage payment. And I worked with Dr. Barry Sachs on that. And so I can send a white paper that would take a lot longer to discuss. If Pauline would like some more information, or any of you would, just email me and I'll send that out to you. But the tax advantages are huge. I will, when I started looking at this for myself personally, I will say, if tax rates do not go up, and I expect them to go up over the next 20 years, I will save in taxes, not defer. I will save $150,000. That negates a lot of the expense of a reverse mortgage, including the interest.
Yeah. Okay. So can we actually just speak to the sort of the mechanics? So when you're getting, as you refer to as a forward mortgage, right? We typically look at somebody's financials, their tax returns, W-2s, pay stubs, their bank statements, things like that. What do they look at when somebody is applying for a reverse mortgage?
Sure, I'll take that. So there is a financial assessment associated with a reverse mortgage. That was put into place, I don't know, maybe 7-8 years ago. And the financial assessment, the intent of that assessment was to ensure that the borrower has the ability to, one, live and cover their expenses, and two, that it would reduce the potential of default on the loan. And you can default on this loan if you do not pay your taxes, your property taxes, your homeowner's insurance, or you allow the home to go into disrepair and it can no longer be insured. So the financial assessment isn't as stringent as a standard forward mortgage, but it's a key component to keeping people out of trouble. So we look at that. We look at history of payments. If you have been late on HOA dues in the last 24 months or mortgage payments, there are certain things that can go in to that reverse mortgage now. And an assessment will help decipher whether a lifetime expectancy set aside is necessary, or a LISA, it's also referred to as. That lifetime expectancy set aside is an amount of equity that is set aside, not utilized until the borrower needs it every year to pay their taxes and insurance. So it's different than a standard forward mortgage, but there are some of the components to a standard mortgage that are utilized in the reverse. Does anyone want to add to that?
Slightly, and that was a good explanation. What we look at, Gary, is it's a lot like a VA loan, residual income. So there's no ratio. So you start out with, Social Security, pension, and then you take out taxes and insurance, you take out other items that are on the credit report, and you come down to the residual income number for the household size. And so in a lot of ways, it's a lot easier way to qualify. And they'll even look at things like asset dissipation. Harlan's got $1 jillion in an IRA, so they'll look at that money and dissipate it, pretend it's being paid out over the life expectancy and count that as income. So it's really set up to, I thought FHA did a pretty good job. It's allowing people that can make this work get a loan. And that Lisa, that's saying, that's like the second, the backstop where you're saying, well, it looks like you could, but you kind of had a bad experience paying your taxes, insurance, and we'll take care of that. We're going to set that money aside. And now it's not a consideration for foreclosure. So, and on credit, the nice part is we're not concerned with credit score. It's credit history. And as Tom's pointing out, we look at how they paid over time. And if they've done a good job keeping up with things, their credit score is lower than you normally do on a traditional loan. That wouldn't be the impact for us. So they really did a good job of allowing people that can perform in the loan to get the loan.
Anything you want to add, Harlan?
Yes, the idea of this is a common sense, which when you put government and common sense underwriting into the same sentence, a little bit crazy. But believe it or not, it is true that it's pretty common sense because the payment is always zero. You just have to have the ability to pay taxes and insurance. It's truly a retirement loan because you're not going to be working for the next 30 years when you're 62. So the issue that it scares me is there's a lot of people that are doing fine today. I could have qualified for a forward mortgage when I did my reverse, but why would I get a required payment when I can get an optional payment? So I would argue that regardless of whether you can afford a mortgage or not, always get a reverse mortgage when you get to 62, because if you want to make the payments, you can. And if you don't want to make the payments, you don't have to. You can pay once a month, once a year, once every 3 or 4 years, or a year after you're dead. It's up to you. So it's a very flexible payment. But I've run into people, especially husbands and wives, when the husband dies, which typically he goes first, everything was rosy when they were both working and before they retired and they were both alive. And then the husband gets sick and he dies, and then she stopped working to take care of him. And all of a sudden, everything changed. It is dangerous to go into a forward mortgage at 62. What is the chance of my wife and my income going up for the next 30 years? What's the chance of one of us dying over the next 30 years? Extremely high. So why would we get a regular 30-year mortgage? It's designed, the qualifications are designed for people like me that are 62, not 32. My kids are in an entirely different situation. In the next 30 years, their income's probably going to go up, and one of them are probably not going to die. So why should old people like me get the same thing as what young people are getting? It doesn't really make sense. So that's why I've got an old person's loan.
Okay, I'm going to object to that, Harlan. You're not an old person. Stop it. So I've got one. I've got a reverse as well, and the hair color tells you why. But here's my take on it, and I applaud. I remember reading something where Harlan's saying, "Hey, if you're in the reverse business and you don't have a reverse, what are you thinking?" And my philosophy is the same. I know what it does. I know what the power is. I'd be an idiot not to do it. So same thing. It's set up for us seasoned citizens. So it's a good program.
Yeah, well, I'm one of those outliers that really work with clients on reverse mortgage and don't have one. But I'm the young one in the group, so I'm just not qualified.
You'll get there.
Well, Tom, you could get married to somebody older than you and could get in. So if you're not,
yeah, well, my wife is older. She's 6 days older, and I don't let her forget that.
So I do have one last question, but before I ask that question and go into sort of other questions from the attendees, I would like you guys to put your contact information in the chat, so that way, if any of the attendees do have additional questions, they can reach out to you guys directly. So if you guys could take a moment, just put that in there. So I guess my last question is relatively pretty simple. If you guys could just share with us a loan that you guys worked on that you remember that helped out the family, and something that we wouldn't think of for a reverse mortgage. So Whoever wants to go first.
I can go first while they're typing. By the way, I put my contact information in. You can buy my book on Amazon for like $18, or you can get it from me for free. So you can weigh out which is the better deal, because I want to help more and more people with this. The one that I remember the best, I grew up, I spent most of my career early on in central Wisconsin, where I grew up. And there's a very large group of Hmong families that ended up in central Wisconsin. And so it was a big part of our culture, a big part of our population in that area. And so I did a loan specifically for a Hmong family that initially was very resistant, because they said, we're first generation homeowners. And, we want to make sure that our children can have this home. Well, they had 4 children. I said, well, which one is going to get it? And they said, well, they can divide it up and they can sell it. And they hadn't thought it out real well. I said, why don't we just pull enough out to give each child enough money so that they are going to be able to each of them can get a home. And fortunately, this was a few years ago, fortunately, over the period of a 2-3 year period of time when interest rates were below 3.5%, all 4 of the children. So there's 4 Hmong families in homes today, because we were able to help mom and dad had the foresight to be able to see that. That was pretty exciting. And it was a special privilege to be a part of that heritage.
Thank you. Tom, Des, do you guys want to share a file or case that you've worked on?
I'll throw one out. It's interesting. I do a lot of realtor conversations, and it was just a one-on-one in the office, the realtor's office, and we're talking about the strategy that Harlan talked about. It's like you do the reverse mortgage, pay off your existing loan, but then continue to make payments when you want to. And so the balance of the loan's going down, and the line of credit available goes up dollar for dollar. Plus there's a growth factor on top of it, another story. But the point is, over time, this client's creating equity in the home, but also creating this nest egg, this safety net of money for retirement. And so we're just talking in general. I said, I looked at this is a great strategy. And she says, that's my strategy. I want to do real estate because I want to, not because I have to. Let's get started. And so it did make a huge difference in her life, and the strategy itself is going to protect her for the long haul by paying in and having more those funds still available in the future. So that one was like, it stuck out to me. Let's just put it that way.
So I had a client, and it's difficult for me to choose one, but one client had called me out of the blue. And she actually lived about a half a mile from my home. And I asked her, how did you hear about me? And she said, Tom, I heard you on the radio. You were being interviewed on a Sunday morning by an estate attorney who had a radio show. I said, that was 3.5 years ago. And she said, yes, it was 3.5 years ago. And I put your name and your phone number on my refrigerator that morning. And my name and my phone number was handwritten on her refrigerator for 3.5 years before she called me. I said, well, why did it take so long? She said, well, I just wasn't sure. So I met with her. We spent an hour and a half together understanding what she wanted to accomplish, what she needed. She was still hesitant, obviously 3.5 years with my number on her refrigerator. I asked her if she had an advisor or a friend that she would like to run this by. I'd be happy to explain it to them as well. So did the same thing a week later. Immediately following, she went to counseling. We established the reverse mortgage. She took a monthly payment for the rest of her life. 3 years later, we refinanced her loan, and she almost doubled her monthly payment because the home value increased significantly. It's scenarios like that people are hesitant because they've heard negatives about it. But one question I'll always ask is, if you have a friend or an advisor that has a negative perspective or says don't do this loan, ask them specifically why, and I'll answer that question. If they're on track and they're accurate, I'll give you the straight skinny. But if it's a misconception or it doesn't apply to you or that's an old product, I'll explain that to you as well. And that's the important thing, is to really dig through all of these negatives so that people can utilize this equity and have a much more comfortable life. Because I think Harlan and Des would agree that many of their clients that they go back and talk to are so grateful that they've done this loan, and they kick themselves for not doing it earlier because they had this negative perspective and they didn't have the education that professionals like us offer and help them accomplish their goals.
Yeah. It's the negative content, the negative perception. It's sort of like when I got into the mortgage industry back in 2004, they came out with a bunch of new products at that time. You had the 40-year mortgage, and then they combined that with the adjustable rate mortgages on a 40-year term. And then lo and behold, we also had the option arm, which, listen, they were a great program, but if you weren't educated on it, it could have been a horrible program for you. So, I mean, it's all about education. And I want to thank all three of you for being here to educate us today regarding reverse mortgage. At this time, I think we're done with what we wanted to present. Is there any questions from the attendees? So it seems like Rika asked, do all lenders have the same HECM loan?
I'll answer that. The HECM loan is standardized. So Des had earlier mentioned that you plug in the age of the youngest borrower, the interest rate of the product, and the value of the home, and it spits out the equity that the borrower has access to. So HECMs are the same regardless of who the investor is. However, there are proprietary loans now that have been around a while that allow a higher amount of loan, jumbo loans, different characteristics to these loans. So there are several different options that you can go to. But if you're comparing a HECM to another HECM from different lenders, you might have some variation in costs associated between those two different lenders. But it's all going through the same formula that HUD and FHA establish. Anybody want to add to that?
Yeah, I think the biggest thing to be aware of is that it's not so much the product. It's a little bit like when computers first came out. It wasn't so much the brand of computer; it was where you bought it and the people that taught you how to use it. There's a lot of people in this space, especially now when the forward mortgage the forward mortgage business got a little slow, that all of a sudden jumped in and said, "Hey, I'm a reverse specialist," and they did 2 in the last 5 years. Beware of people like that, not because they're dishonest, not because they're awful people, but simply because they don't really understand, and they might give you information that is really not correct. And that's the bad thing that we're concerned about in this industry. And so that's why Tom and Des and I are so lucky to be on this call. And Lynn Coffin as well is on this call, that actually does the loans for us, along with a couple of other retirement mortgage professionals at Movement, because it's important that the person you're working with understands the tax issues, understands, just ask somebody about the tax issues that are revolving around it. Ask them about when it's actually due. Ask them about what they would tell their children about this if they died in 5 years, so on and so forth. And pretty soon you'll get a pretty good idea if they're one of the advantages of us being old, is that we have a lot of experience and knowledge, and we can kind of smoke out things when people are telling us a story. And so, most people our age kind of get it when somebody's selling as compared to somebody educating. And so I think that's the important thing from a product perspective is it's not as important what the product is, but as important how it's being used and how it's being explained to the kids and so on. Rika mentioned something early on about what happens when, everything's great when the values are going up, but what happens if your loan balance that you started with goes up and does not keep pace with the value of the home. And that's the thing you don't have to worry about, because my uncle, which is one of my first clients, died in 2009 when the value of his house went down and he owed more on his house than what it was worth. At 94 years old, he had $300,000 in other assets, which all passed to his heirs. But the $40,000 that he was upside on his house was paid for by the FHA mortgage insurance. And that is a huge value and a huge safeguard. Quite frankly, if the non-recourse factor was not in place, I would not be involved in this industry, period. Because there's way too much danger around that. That's what happened with the neg am option arms, is the value went up higher and the party was over. And that is not something that can happen with an FHA HECM. And that's what's very, very encouraging.
Des, do you want to add any last words?
Well, it's hard to add to that. I mean, at the end of the day, if it's last words, what I would say is, Harlan and Tom, they're experienced people. I've been in the business a long time as well. And the idea is that if you're going to explore this product, you just have to have the knowledge. And a lot of times there's no substitute for experience. And you can study, and that helps. But at the end of the day, as an industry, we don't want to be tarnished by people that are explaining things incorrectly or leaving out information that could be beneficial for the client to make a great decision. So at the end of the day, having somebody that's experienced in the industry is really a good thing. And I, frankly, I'll take other questions, but I'm just honored to be on a panel with these guys. Awesome human beings, good for our industry. And so if there's anything that, any of us can do to help another person look at this and understand it and then see how it could help their career or their clients, we're up for it. So thank you.
Well, thank you three for being here. I definitely appreciate it. If there's no other questions, I guess we can close out the webinar.
Gary, if I could add one more thing, Gary, on what Tom said, don't wait. I've done 1,000 of these, more than 1,000 personally. I keep in contact with my clients over the last 20 years. Do you know that not one of them, not one, has called me and said, I wished I wouldn't have done this. But many of them have said, why didn't you tell me about this earlier? When somebody, I will never forget when I was talking to somebody that didn't know these existed, and they moved off their beautiful lakefront property into a little cracker box condo. And they said, if we would have known about this, we would have never sold our lakefront property. We could have stayed there and been in paradise for the rest of our retirement. So, don't be like Tom's client that puts it on the refrigerator for 3.5 years. That's waiting too long.
Well, once again, I want to thank everybody for being here. Thank you, Tom. Thank you, Harlan. Thank you, Des, for being on the panel. I do have one last announcement that the Mortgage Committee is having another webinar next Wednesday, June 7th, regarding down payment assistance. It's titled Show Me the Money. Please look out for the AREAA National email to register. Thank you guys so much for being here, and have a great rest of the day.
Thank you, everybody.
It was a